Hello and welcome to Portfolio Matters. In recent weeks, we have been talking about the impending European energy crisis this winter, which I believe is the most important economic development in the world right now. And potentially, we will have the worst energy crisis in generations in Europe this winter, which will have profound economic consequences and massive consequences for your investments. But before I get going, a quick disclaimer. As always, please do your own research. Everything in this podcast is our opinions. It is not advice. A full disclaimer can be found at the end. Okay, so during the month of June, Russia progressively reduced gas supplies by pipeline to Europe. And this week, gas flows through the Nord Stream pipeline to Germany have stopped. Now, that was due to scheduled maintenance, but even before that, gas flows were falling, and the fear is that that pipeline will not reopen. Russia and Europe currently are conducting a proxy war in Ukraine, and Europe is heavily dependent on energy supplies from Russia, and essentially it is dependent on its enemy for its energy security, and Russia are likely to take advantage of that to cause immense economic disruption to Europe in the coming winter. Now, medium term, this can be solved by the EU building lots of pipelines to North Africa, where there is gas in Morocco and Algeria and Libya, and by building new LNG terminals to receive LNG supplies from primarily North America. But this winter, there are few alternatives. And if Russia cuts off gas supplies, Europe will be short. This chart shows gas pipelines into Europe, and they come from either Norway, Russia, Azerbaijan through Turkey into Bulgaria, or from North Africa into Italy and Spain. Now, the pipelines running from Norway are running at full capacity, as are those running through Turkey and from North Africa. Essentially, all those are maxed out. There is no spare capacity there. So, to replace Russian supplies, the EU has been relying on LNG supplies from around the world, and it has been outbidding Asia to procure particularly North American LNG cargoes. Now, this chart shows where all the LNG regasification plants are in Europe. And you will see that Spain and Portugal have a few. France has 3, but there are none in Germany. There's one in Poland, a few in Italy. The UK has 3, but the regions with good LNG supply, so that is Portugal and Spain and the UK, have limited export routes to Europe. So the UK is currently exporting at full capacity, and Ofgem, the UK regulator, has stopped additional LNG cargoes to the UK because it is worried about overpressure in the UK gas pipelines because it can't export as much as it would like. It is at full export capacity. In Spain and Portugal, there's only really one main export route to France, and that is running at full capacity. So mainland Europe suffers from a lack of LNG regasification plants. Now, that can be rectified in the medium term, but those plants take years to build. And new ones will not be in time to solve a crisis this winter. This chart shows Russian gas flows into Europe via Nord Stream. And you'll see that it had already been reducing gas flows through Nord Stream before the maintenance this Monday. And the fear is that it will not restart on the 21st. And these are overall gas flows from Russia to Europe. And prior to the pandemic and the Russian invasion of Ukraine, they were running at around 375 million cubic meters per day. And currently, they're running at around 40. So they're running at, let's say, a ninth of their earlier levels. So Europe has seen a massive reduction in Russian gas flows. So on this chart, the orange line is Russian gas supplies to Europe, and the blue line is LNG imports to Europe. And you'll see that as Russia has reduced its exports, so Europe has turned to LNG to replace them. But LNG imports are now maxed out. Europe is importing as much as it possibly can. In order to import more, it would need to build more import terminals. So that means that Europe is unable to get as much gas as it needs to rebuild stocks before winter. And if Europe were to use gas at its usual rate in this winter, it would run out. And so this chart shows you the likely path line for European gas stocks under the scenario where in the red line, it uses gas at its usual rate, and the light blue line where it reduces demand by 15%. So it won't be able to consume gas at its usual rate. If it did so, it would run out. Hence, it will need to cut gas demand. Now, the question is, how will that be achieved? Will it be done through rationing or allowing the gas price to rise to the point where there is demand destruction? It is likely there will be a combination of the two. The other thing to make clear is that the effects of the coming gas crisis will be asymmetric. Some countries will do much better than others. So Austria, Czechia, Slovakia, and Slovenia do moderately well. If they consumed gas at their usual rate, then they would run out of gas towards the end of March next year, so towards the end of winter. Belgium and the Netherlands do not do so well. They would run out by early March, late February. The Dutch obviously have big natural gas fields, which they are choosing not to fully exploit because of fears over earthquakes. But that could change and they could start to fully exploit those fields, in which case they might have a better outcome. Southern Europe is in trouble. So if they were to use gas at their normal rate, they would run out of gas supplies by late November. Denmark and Sweden would run out by early February. Estonia, Finland, Latvia, and Lithuania are very heavily dependent on Russia for their supplies. They would run out by late November. Spain, Portugal, and France, they have LNG regasification plants. Essentially, they will be okay. They will not run out of gas. They will be able to consume gas as usual. Germany, though, has no regasification plants. It would run out by late January. Italy, run out by mid-March. Poland, very heavily dependent on Russian energy. it will run out by mid-January. So the bottom line is that the impending energy crisis this winter will have very strong asymmetric effects across Europe. Some countries will run out of gas very quickly unless they cut back hard on their gas usage. Other countries will be largely unaffected. And that means that their GDP, their output, can continue as normal, whereas countries which are heavily dependent on Russian gas, such as Latvia and Germany, will have to cut back hard on basic industry and energy intensive industries in order to have enough gas for electricity production and domestic heating. So that will add to the fragmentary forces in the Eurozone. It will also create a financial crisis potentially, as some basic industries are forced to close down either temporarily or permanently. And if they have borrowed money in financial markets from banks, then those banks may find themselves financially stressed. And if the banks find themselves stressed, then there is the possibility of contagion and a widening financial crisis. Now, this chart shows gas prices in Europe on the futures curve and how the futures curve has changed. So in March, just after the Russian invasion of Ukraine, the markets were expecting gas prices to come down relatively quickly. They are now no longer doing so, and they're expecting elevated gas prices in Europe for several years to come. Bear in mind that gas prices in Europe are currently over 20 times more expensive than in the US. So this is gas storage in Germany, and the grey band is the seasonal range based on the experience of previous decades, with the dotted line being the seasonal average. The orange line is 2022. And what is particularly worrying is that in recent days, Germany has had to withdraw gas from storage to allow electricity generation. And that is very much against the seasonal norm. At this time of year, it should be building stocks for winter. Italy shows the same pattern, but even worse. So Italian gas storage is currently well below historic norms, and it has had to withdraw gas for power generation in the last few days. Again, very much against seasonal norms. France, though, looks fine. Now, the UK also looks fine, but that is largely because the UK currently has very little gas storage. It runs on a just-in-time basis, and we closed the biggest gas storage facility, the Rough storage facility offshore Northumberland, a few years ago, and there are plans to reopen it, but that will take some time. But the biggest problem for the UK is it will also rely on LNG imports for its marginal gas supply this winter, and it will be competing in the market with Europe for those supplies. So it will have to pay the same price. So UK gas prices will be very correlated with European ones. So this is the overall European picture, and gas storage is not looking too bad actually compared to seasonal norms, but there's been an unseasonable drawdown in the last few days, which is concerning. Now we're in the summer period where gas demand is falling, and it bottoms in July and August, but then it starts to rise rapidly in September and October. And bear in mind that some of the Eastern European countries will be starting to run out of gas by late November. So, what will be the effect on European consumers of Russia completely cutting off gas supplies to Europe? Well, the forecasts are that power and gas bills could rise by around 300%. These figures are for Italy, and they're forecasting in Italy that energy bills would rise by around 300% if Russia completely cuts the gas. So, in conclusion, if Russia continues to cut gas supplies to Europe, there will be a severe energy crisis this winter. Basic industries will have to shut down, and that will have knock-on effects on supply chains and on inflation and other industries, and there may well be rationing. Consumers' energy bills will go through the roof, and that will mean a severe recession as they are forced to cut back on other expenditure. In addition, as companies are forced to cut production, their profitability will collapse and they may well go bankrupt, which will cause financial stress. In addition, there will be strong asymmetric effects within the Eurozone. So some countries will do well while others suffer. And the Eurozone has not been set up to allow fiscal transfers, and that will cause political and financial stress in the affected countries. Now, we've seen in Sri Lanka what can happen when there's a financial crisis leading to an energy crisis. And in Sri Lanka, essentially, we've had the fall of the government and total societal collapse. Now, I'm not forecasting that, but it's a harbinger of what could happen in a severe crisis. So, what are the investment implications? Well, we're going into a crisis. You want to be avoiding risk assets. Also, you want to be quite careful about which safe havens you choose. So, it is an open question whether the government bonds of countries which will be severely affected by the energy crisis will be safe havens. What is clear is that the US is a safe haven. It is energy independent, and the Fed is raising interest rates to combat inflation. So the US dollar has been rising against all the world's currencies, and currently I see no reason why that should not continue. So I have personally moved all my assets into US dollars. Can the EU survive the loss of European gas? Well, it will have to. And these charts show a possible solution. So the brown bars are the total amount of Russian gas supplies that need to be substituted. Now, the red bars are the amount of gas that we have already received from Russia this year. The purple is LNG imports, which will replace a large portion of the missing gas, but I'm afraid a lot of the rest of it needs to be met by demand reduction, i.e. adapting and not burning the gas. So we're going to have to see industry and residential all cutting their gas supply. In the case of the power sector, which is where the majority of the demand reduction needs to come from, that can be met by substituting coal for gas. So these three scenarios show how power consumption can be met. So in the high coal case, there's only a 22% reduction in demand, power output, and most of the loss of gas is met by increased coal. And then essentially, renewable energy can only substitute a small portion of the missing power. And you either have to burn a lot more coal or you have to cut back hard on electricity demand. And this chart shows European thermal coal imports by sea. And you'll see that the dark blue line at the bottom is imports from Russia, and they have also fallen this year. So in order for Europe to meet its increased demands for coal, it will have to compete on the international market to not just replace its missing imports from Russia, but also to massively grow its import requirements. And regular viewers of the weekly will know that coal prices have risen 150% this year, and that will mean Europe having to buy coal at record prices and probably drive the price up yet further. So we've seen that the European balance of payments has deteriorated and that Europe already runs a trade deficit. That is likely to get worse, which will be very bad for the euro. But the good news is, even with burning more coal, European carbon dioxide emissions are likely to fall because demand destruction will outweigh the additional carbon emissions from burning coal. So in summary, the EU will be able to keep the lights on, provided that it can get continuing LNG supplies, and there should be no reason why that can't be the case. But also, it needs to burn a lot of coal, and it will need to secure those additional supplies. But in all scenarios, there will need to be demand destruction. And demand destruction can be achieved through rationing or higher prices, but most likely both. And finally, John Kemp of Reuters has recently posted about the UK winter fuel crisis of 1947. And I'd briefly like to discuss this because I think it's a good analogy for how a crisis develops. So the background was that during the 30s and 40s, the UK had struggled to increase coal output due to nationalisation, underinvestment, labour disputes, and particularly during the war, diversion of labour to the armed forces. And so after the war ended in 1945, the UK built a load of new power stations, electricity being the new energy, but coal supplies failed to keep up with the additional demand, leading to a fall in stocks. Now, in the winter of 1945-46, we almost had a fuel crisis, but we managed to survive without having to cut power generation. So that was the situation going into 46-47. Now, what's really interesting was that the government failed to react. And despite lots of forecasts that the UK would face a winter fuel crisis in the coming winter, they did nothing except issue bland pronouncements saying everything would be all right. So this shows UK coal stocks over the period, and you see that in 1946, coal stocks had fallen to a low. And this is UK coal production and coal shipments over the period 39 to 45, and you'll see they were stable and declining. The UK was failing to increase coal production. This is domestic coal consumption, and you'll see that consumption was rising even though production was stable and falling, leading to reduction in stocks. I'm going to read this out. This is a quote from Emmanuel Shinwell, who is the Minister of Fuel and Power, and he made this on the 24th of October, 1946, i.e. at the beginning of winter. Everyone knows there's going to be a serious crisis in the coal industry, except the Ministry of Fuel and Power. I want to tell you, there is not going to be a crisis in the coal industry. If by crisis you mean that industrial organization is going to be seriously dislocated and that hundreds of factories are going to be closed down. So the government was very confident in its public prognostications, at least, that there was not going to be a crisis, and they did little. But then on the 7th of January 1947, so 3 months later, the cabinet met to agree an emergency reduction of 50% in coal supplies to industry. And electricity generators started to run out of coal in January and February. Power cuts led to widespread factory closures with millions temporarily thrown out of work. And we can see that in the unemployment numbers for January to April 1947. There was a big temporary spike in unemployment as workers were sent home. So the causes of any energy crisis are long-term failures in energy policy, which we have very much seen in Europe, which has relied for its energy security on Russia, which has proved to be an unreliable partner. It has failed to maintain spare capacity and failed to maintain adequate inventories. And the UK is very guilty of this, having closed down most of its storage facilities. And the failures in long-term policy are then revealed by a precipitation event. And in this case, precipitation event is the Russian invasion of Ukraine and them cutting off gas supplies. What follows is an energy crisis and panic. You'll see that in Britain in 1947, there was general concern of the possibility of a winter fuel crisis, but the government refused to acknowledge it until it was too late, and then had to impose severe restrictions. If it had reacted earlier, those could probably have been avoided. Now, what I notice is that although there is some discussion about a possible crisis this winter, and the chairman of Shell has recently been talking about this, that they're really in markets are relatively calm about it. And I think they will not react until the fuel crisis is live and beginning to curtail production and hitting companies. So as investors, try and be in advance of that and react before the herd. So in conclusion, I think a winter fuel crisis is coming, and it will have big economic effects, cause disruption throughout Europe and the UK, and will be the biggest energy crisis in a generation. So be warned, be prepared, and try and protect your portfolio. Okay, that's it. Please can you press like and subscribe to the channel, and it is goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.